In this presentation, we will take a look at business income as it relates to a sole proprietorship reported on a Schedule C. We're focusing in regards to our income tax equation up top in the income section, recognizing, however, that this would be reported on a separate schedule, that being the Schedule C, which have an income and an expense portion or a deduction portion that will then flow forward to the first page of the 1040 that would be reported in the income section on it. This is the actual 1040. We're focusing here on line 7A. That then would be supported by Schedule 1, line 3, which would then be reported or supported by the actual Schedule C form. Business income. If there is a connection between any income you received and your business, the income is business income. A connection exists if it is clear that the payment of the income would not have been made if you did not have the business. So anything that you receive an income that's connected to the business is business income. That means that you don't necessarily get a 1099 form for it. In other words, you may not get some form that reports the actual income as you would for most other income. In other words, if you worked somewhere else, you'd probably get a W-2 form. Or if you got income from like dividends or interest, you'd probably get a 1099 form. If you work in a business, your own business, you may get another form. You may get such as a 1099 form. However, the 1099 form isn't the thing that's going to tell you necessarily that you need to report the income. It will tell you that you need to report that income, but the fact that you did not get a 1099 form does not mean that there's no income that should be reported. Any kind of income that's being received that's connected to the business, in other words, if there were no business, you would not have the business income, therefore it's connected, that's the general rule for it, should be reported as income on the Schedule C for the sole proprietorship business. You can have business income even if you are not involved in the activity on a regular full-time basis. Income from work you do on the side in addition to your regular job can be business income. So in other words, you may have a W-2 job, you may have some Schedule C business or sole proprietorship business on the side. You don't have to be working in it full-time for it to qualify as a Schedule C type business that would need to be reported. Yes, if you made money, in other words, the IRS silent partner would like their share of it, even if you have another job. You report most business income, such as income from selling your products or services on Schedule C or CEZ, but you report the income from the sale of business assets, such as land and office buildings, on other forms instead of the Schedule C or CEZ. For information on selling business assets, see Chapter 3. So for normal type of sales that we have, including if you sell inventory, the purchase and sale of inventory would be typically reported on the Schedule C. If you sell something else like large assets that you had, like equipment in the business, you may have been using the equipment in the business, but if you sell it, then you're going to need other forms to calculate the sale or to report the sale of it, in part because you're going to probably be dealing with like depreciation, and it could be capital gain type information with regards to those. Now, how do you know what the difference is between inventory and some other kind of asset that was sold? The inventory, when it was purchased for the purpose of making money by selling of the inventory, marking it up and selling it. If you have equipment or something like that, it was purchased for the purpose of using the equipment in order to generate revenue. Therefore, you could have one item like a forklift, which could be inventory to one company that uses that forklift, just buys it and then sells it, marks it up, that's the inventory of the company. Or another company, it could be equipment, because of the intention of the forklift is not to be resold to generate a profit, but to be used within the business. You still may sell it at a later time, but in that case, it wouldn't be selling of inventory, it would be selling the fixed asset. Items that are not income. Appreciation, increase in value of your property are not income until you realize the increase through the sale or other taxable disposition. So if something goes up in value, let's say you have possibly you have building or land that is part of your business maybe, and it goes up in value, it appreciated instead of depreciated and didn't go down in value, it went up in value. Well, typically you're not going to be reporting income on that appreciation because you haven't realized it. You haven't sold it yet. And this is a good thing for taxes because it wouldn't make sense. It would be difficult in some cases if something went up in value. You had to report the gain as income on it, but you don't have the cash because you didn't sell it, you didn't realize it. It just went up in value, and therefore, the tax could actually require you to sell it if they were to tax you on it. So you don't generally get taxed on it until the point of sale when you realize it. The other justification behind that law would be that the market goes up and down. So if it went up this year just because the market went up and there was no actual realization of the sale, then it could go down next year. You don't really know. So those are a couple of reasons why you typically would need to realize it before you would have the income reported. Consignments. Consignments of merchandise to others to sell for you are not sales. The title of merchandise remains with you, the consignor, even after the consignee possesses the merchandise. Therefore, if you ship goods on consignment, you have no profit or loss until the consignee sells the merchandise. Merchandise you have shipped out on consignment is included in your inventory until it is sold. So in other words, you could have an agreement with a consignment. That basically means that you're giving your inventory to someone else to go through the process of selling without them actually owning the inventory. In other words, you still own the inventory. This other person has it. It's in their location. For example, I did some bookkeeping once for a restaurant which would take art from local artists, put it in their restaurant, and actually facilitate the sale within the restaurant. When they sold the art, then they would give the proceeds or most of it to the artist. That would be a consignment type situation. When the artist gave the art to the restaurant, that wasn't a sale, even though the art is no longer in the possession of the artist. It's now in the restaurant, and so the inventory then would still be in the possession of or recorded for the artist, even though it's not in the artist's location. This can be confusing because generally when we want to prove that a sale has happened, when we think of when did the actual sale takes place, usually that happens when the job was completed. With regards to inventory, that's usually when it's shipped. So normally we think of if it was shipped, if it's left the location, then it's no longer in inventory and a sale has happened. However, if there's this consignment kind of situation, that's not the case because the inventory has been shipped, it's in some other location, but it's still technically owned by the person who shipped it. And so that's going to be kind of an exception to the normal rule that you would see. Exchange of like-kind property. Generally, if you exchange real property used for business or held as an investment solely for other business or investment, real property of a like kind, no gain or loss is recognized. This means that the gain is not taxable and the loss is not deductible. For more information, you can see Form 8824. So why might we have something like a like-kind exchange? What's that doing in the code? Note that what we don't want from the tax code is for the tax code to stop transactions from happening. So we want it to not have an impact on normal business transactions that might take place. And you can see if there's some type of transaction, say you have a vehicle and you're going to purchase another vehicle and you want to trade in the first vehicle. If something like that happened, but you had fully depreciated the vehicle, and if you trade it in then and you receive anything for it, then typically you would have to record that as income, and you'd have income on that you'd have to pay taxes on, and then you'd be purchasing the new vehicle, which is basically just replacing the other vehicle. So in that case, if you had a situation where you had to record income on that, it might stop people from basically making that kind of trade, that kind of deal, which they would typically want to do if it wasn't for the tax situation. So in other words, they're basically saying if you're trading one thing of a like kind, you're using it for business, and let's imagine where you're using something for business, say a vehicle, and you want to trade it in for another vehicle that maybe is more appropriate towards you, or it's beneficial for the two parties to be trading these vehicles, then at the end of the transaction, you're basically in the same situation as you were before the transaction. And therefore, it would be a like-kind exchange, and you would think that you shouldn't have any kind of tax consequence in that. So the IRS is basically saying, if it's a like-kind exchange, we're going to make it like a non-tax event, and in essence, you're going to carry over the basis of the prior property that you had to the new piece of property, and then if you sell it, then you can recognize the gain at that point in time at the sale, because the basis will be lower, and you'll recognize the full gain related to it. Now, it gets more complicated when you have an exchange. Say you exchanged a vehicle in and you had some payments related to it. Then it gets more complicated in terms of how do you record the new vehicle on the books for. So you can get into more detail on what kinds of property qualifies for a like-kind exchange, and exactly how much of the gain you got to recognize and what's going to be the basis within the like-kind exchange. That's a whole other topic that we can spend a lot of time on. But that's kind of the rationale between the like-kind exchanges. Basically starts out by saying if people are going into a transaction and they're basically ending the transaction in pretty much the same situation with different pieces of equipment, they're trying not to have a tax consequence for that type of transaction so that it doesn't discourage that type of transaction from taking place.